So with that, we can kick it off. TJ and Jim, thanks for being here. Thanks for everybody else from SumZero and those listening on Twitter for joining and I guess pre-gaming the Fed rate decision in about an hour. So we'll try to keep it at about an hour so everyone can turn over their entire portfolios starting at 2 p.m. Eastern and buy everything or sell everything higher and buy it back lower. So the format for this, the intent here is going to be a conversation. It's going to be interactive. What the hope is for both for me, but for AvePoint as well, is this is going to be hopefully a little bit more valuable than the standard sell side fireside chat. We want to dig into the real stock and business drivers here. And I should mention, I think SumZero mentioned it at the top and in some of their emails. If there are questions, you can try to drop them in the chat here. You can also email sim at sumzero.com, and they'll try to get the questions over to me because I think everybody else is on a listen only mode. And we'll assume that only some of the people on this call and listening in read the write-up we posted on SumZero several months ago about our investment in AvePoint. So I'll just start off with, look, why we're here, why we're doing this. My name, just by way of introduction, is Shah. I'm the co-founder and co-PM of Stoic Point. We're an investment firm based in Palo Alto. Stoic Point focuses on misunderstood businesses, generally in the small and mid-cap space, where we find that prices generally don't reflect the fundamentals for really any number of identifiable reasons. One of those reasons is capital markets dynamics, new issuances, and that's kind of why we're here today. In the past 2 years, the de-SPAC space or subsector has really been a core focus for us, as we've seen a lot of companies, 300 plus, come public by means of SPAC in the last year or two. We actually manage 2 funds, and one of them is focused on SPACs exclusively, or de-SPACs, I should say. And look, it's not controversial to say that most of the businesses, the vast majority of the companies that are coming through the de-SPAC route and coming public that way, tend to be lower quality businesses for a variety of reasons. But we think certainly with what's gone on in the market overall, the baby's been thrown out with the bathwater. And we think AvePoint is one of those businesses that's kind of been thrown out there. Oftentimes for us, we ourselves at Stoic Point, we start with the sponsor of a SPAC to understand the quality, if it's likely to be a good deal, if this is on brand, it's something that the sponsor knows. We've evaluated, I'm happy to say, pretty much every deal that's come through the pipeline in the last year or two. And this is how AvePoint actually came on our radar, was a high quality sponsor took the company public. The fact that the business has been around for over 20 years, it's not a vertical takeoff taxi company or an EV company that's been around for a couple of years. This is a 20-year-old business that started with, I believe, only about $60 million of equity capital 20 years ago, has a great financial profile and growth compounding over 30%. Those are the types of things that made us dive deeper into the business. And subsequent to coming public, the company's executed fairly well. There's not a lot of de-SPACs that have beat and raised, that have hit or beat their initial projections that they put out in those decks. And AvePoint has, for the most part, done that. There's a slight change in the revenue accounting thing that I'm sure we'll get to with Jim on there. But otherwise, the company's executing really well. And so where it sits today is AvePoint's growing 30% plus. It trades for less than 3 times revenue today, surprisingly, and has almost a quarter of its market cap in cash. So it's got a fortress balance sheet. And just as a point of reference, a legacy competitor, someone like Commvault, trades at a premium to AvePoint, trades at over 3 times revenue. And I think Commvault grows something like 5 or 6% a year. And Datto, which is another competitor, is being taken private, I believe. That grows in the high teens, and it's being taken private for about 8 times 2023 revenues. So look, AvePoint's not sitting on their hands. They're taking advantage. They announced not long ago a buyback of about 15% of the market cap of the company. TJ and his co-founder have been buying stock themselves, sadly for TJ at levels much higher than where the stock's at today, but hopefully over the long term, that'll look like a great buy. And so look, it's easy to see that the company's cheap in relative and absolute. We can dig into some of that, but that's not really why we're here. What I want to spend the time with TJ and Jim going through is if that's justified. What could be wrong? What could investors be missing? Why could the security be trading in such a sort of disconnected place? Our view, just to kick it off, is that we think a lot of this is de-SPAC related. The de-SPAC index is down over 70% in the last year. But we also think there's some key misunderstandings here with AvePoint. One is, and we'll touch on this at the start, is how much of this business is truly recurring, how much of this is really SaaS, and how sustainable the growth that the business has been seeing over the last couple of years is. And then two, the business sits directly on, riding the Microsoft wave. And so what does that mean? Is there a dependency on Microsoft, and is that a risk or a threat going forward? And then look, also of interest is the company underwent an accounting change that I touched upon before. Interestingly enough, kind of taking its medicine and in changing the way it's recognizing some revenue that has an impact this year, but then in years going forward will actually converge ARR and revenue growth, which is the right thing to do. And I think clears up the picture a little bit. We think it's smart and savvy because the company's doing it in a year where they're not really even getting credit for the revenue growth anyway. But for us at Stoic Point, the stock doesn't even need to re-rate really to get pretty healthy returns. The company's compounding 30% plus growth. And TJ, it's funny, I heard you last week, I think, speak at a conference and mention that the company's boring and that you like that. And I would agree with that. It's a fast growth, cash generative business in a sector that a lot of people would find boring. And our cursory look at a lot of the write-ups on SumZero, most of them are not boring companies. Most of them have great stories. They're interesting sectors that people know a lot about. And I think the unique thing about AvePoint is there's not a lot of enterprise SaaS businesses written up on SumZero. And certainly within enterprise SaaS, this tends to be one of the sort of less sexy spaces. So we'll spend time on that. And then look, finally, founder-led businesses for us are the best in tech for several reasons. Founders tend to have a lot of skin in the game. They live and breathe the business. And TJ co-founded this business 20 years ago. He's CEO today. And it's rare to have longtime CFOs as well. But Jim, I believe you left AvePoint in 2013 and then just recently came back, which is pretty rare to see. You don't often see that. So look, I'll turn it over to TJ and Jim with kind of just a quick opening question. As I said, I want to dive into the business drivers and the stock drivers rather than spend a lot of time on stuff you guys can see in the investor presentation. Maybe TJ, just to kick it over to you, just a 3 to 4 minute overview on where the business has been and kind of where it is today, and then we can narrow in.
Well, thank you, Raj. Thank you for that overview of your write-up and the analysis here. So yeah, just a quick review of the business. We've been around for 20 years. I started the business when I was still in grad school at NYU doing machine learning and data mining doctorates. And we actually were fortunate to get into the Microsoft ECM space, enterprise content management space, which is called SharePoint, and became the largest on-prem data management software provider in that space. And then 2010 rolls around and Microsoft started to invest into cloud called BPOS. And that was precursor to Office 365. We recognized very early that we should go into cloud, and also that allow us to expand our total addressable market just from only this ECM platform, that's SharePoint, to inclusive of entirety of Microsoft Office, which is email, Exchange, OneDrive, the file shares, of course, SharePoint, and then projects, and of course now Teams with all the chats, private channel, etc. So we have been a first-class citizen in Microsoft Cloud for the last 10 plus years. And that allows us to build up this incredible maturity and sophistication around cloud operations, cloud security. And also because of our pedigree and heritage in the ECM space, we predominantly serve a very large part of our revenue, our governments, as well as regulated industry, banks, financial services, healthcare, manufacturing. And because also the nature of the business focusing large enterprise and governments, we are very global. So our number one business country is USA, followed by Japan, followed by Germany. But North America is 45% of our business, and the rest of it is split between Western Europe. And then also in APAC is all the tier one B2B software markets, which is Japan, Australia, New Zealand, Singapore, and we just entered South Korea as well. So these are our markets. And we create this incredible competitive moat around SaaS data security and governance management for Microsoft Cloud. So you think about business data from emails to contracts to files to chats. We have proper ways to actually help, obviously, customers go onto cloud. From there, backup as service, ransomware detection, and of course, do all the governance, essentially retiring and data through its life cycle, and also control who sees what when, right? So that's our business. Now let's talk about we as a company, where we're going. I mean, from a subscription, I see one person keep on firing a lot of questions, and we'll answer them. Everything is, we have nothing. Everything is full transparency. We're a public company, and we're actually very, very proud of what we have done and our heritage. So when we actually decided to go public, we were going through the traditional IPO route. This is why we actually have great research coverage today, because we put together a syndicate of bulge bracket banks. So Goldman Sachs, Citi, Evercore. And this is essentially October 2020, before election results were known, before there was even a vaccine timeline announced. So there were very, very volatile times, very much like today, right? So at that point, also three out of four IPOs were done via SPACs. SPAC became all of a sudden this new safe instrument for people to go public, and we, as part of our fiduciary duty to our shareholders, explore the option. And that's when we actually run into Jeff as well as Brad of Apex Technology. They're one of the good reputable technology sponsors for SPAC, because Brad Koenig actually made Goldman Tech Banking what it is today. His first IPO was Microsoft. And of course, Jeff Epstein is ex-CFO of Oracle. He personally sits on 5 very, very large software public boards, Twilio, Bookings. So we found good partnership there. And within the matter of a month, we raised basically $140 million from the same traditional large institutional investors as anchor investors for the PIPE process, right? To have the guaranteed. And then we essentially have the value, have that PIPE funding plus the trust funding in the SPAC, and we went public that way. Of course, through the process, there's the SEC change, as you recall, around liability accounting, around warrants, right? So that delayed us a bit. We had no redemption, so that was very good. And then we went out, right? Of course, at that point, the whole SPAC market has turned, because there's a number of companies that should not be public decide to choose the SPAC route to go public. And obviously, we're going to traditional route of business. And you're absolutely right, because the de-SPAC process, where in a traditional IPO, you will have green shoe features, where the bankers will continue to make sure that there's continued institutional investor involvement. With the SPAC process, I would say that kind of the key failing is that the people that put money in the trust in the beginning, these hedge funds, they rotate out, right? So there is no good continued coverage from the bankers to say, hey, bring in additional institutions beyond the PIPE investors. So therefore, you have a lot of retail participation, and there's not enough institutions. So today, 40% is insiders. I'm one of the insiders. I keep buying, as you mentioned. 40% is institution, 38% institution, and rest is retail, right? That's introducing some churn. And there's always this comments like, hey, you guys announced stock buyback earlier. Why didn't you do it more than $1 million plus? Because SEC told us not to do it, right? Right before we list. The SEC say, hey, this is getting complicated. There's governance concerns. You can't do it. So we stopped it.
You're referring to trying to buy back stock even before the deal closed.
That's right. That was the $20 million stock buyback announcement, right? And people, obviously online say, hey, why didn't you do it? Why didn't you stick to your words? Well, the SEC told us not to. And then, of course, post listing, we continue to execute, as you saw, and you noted, we haven't missed a single quarter from our guidance. The Q4 was obviously, if we actually kept the same revenue recognition mechanism, we are above guidance, right? So obviously, with following our guidance from auditors, and also, quite frankly, better for the less chunkiness to the revenue recognition, and Jim will go into more detail on that. It's actually better, right, to recognize far less upfront. So everything is actually smoothed out as subscription, because our blended average contract period is 2.2 years. So, when you do a subscription, everything we sold as subscription, 82% of our revenue today, it's full on subscription recurring revenue. Now, the difference is between SaaS revenue recognition and term revenue recognition, because if anytime you use someone else's private data centers, that's considered term. And how much recognition is that? So we actually think that with the new changes, this matches better on an annualized basis as the SaaS revenue recognition component on an annualized basis. And we have been cash positive. We've been cash positive for the last 2 years. And we also say that we are cash positive this year. The only thing that we're not, quote unquote, profitable it's because the stock-based comp, right? When you take that into consideration. And we have also announced to the public that we are now going forward for our budgeting process purposes, take into stock-based comp into consideration so that we can reach profitability in the short to medium term here, right? That's our goal. But we are cash positive. We're very diligent and good guardian of our fiscal balance. And as you mentioned, we built this business with just $60 million primary capital. In parallel, we raised $350 million. That's all secondary, went back to previous investors with fantastic returns. So we have a great track record of returns, right, to our investors. But now we see, obviously, there's market dislocation. So we had a lot of beating taken out of the stock last year. That's due to the SPAC, baby, throwing out the baby with bathwater situation. And this year, year to date, we're actually doing decently well compared to the entire overall SaaS tech market, right? So that's where we are. But we think that, of course, it's undervalued. We have a very strong balance sheet. So we are doing stock buybacks. We are buying back every week. And the last time we announced it, that we were only into that program for like a little more than 4 weeks, right? So we'll continue to do that. So that's ongoing. Having said that, though, we also think that the best use of our capital is to both organic growth at a cash positive flow annualized basis, but also obviously doing acquisitions. So we have done a tuck-in acquisition in February. We'll announce a few more because we have a very active pipeline. We're actively acquisitive. And we think that actually will lead to a even better shareholder value as we strongly grow the business. Like you mentioned, right? We're looking at 34% ARR growth this year. And we're very confident to continue that for the next 5 years to have a straight line path to $1 billion recurring revenue, right? That's what we stated to do, go from this 9 million plus users to 50 million plus users that we cover. And last year, our user base increased 30%, just as also we forecasted. So everything I feel that we have executed to point where we stated, we're learning in real time, of course, how to be a better public company in terms of communicating a lot of things we're doing across. We're doing a lot of new things, releasing product, really investing channel, bringing senior talent. So all of that are things that's happening, and we feel that, irregardless of the stock prices today and tomorrow, the fundamental of the business is very strong. And I think over time, folks will recognize and shake off that SPAC association and treat us as any real SaaS businesses and going forward. Another flavor we also public shared is that today, 18% of our total revenue is services. And we expect that to go down to 10%. And we're actively working towards that to, again, increase our margin profile. So vast majority of the business will be highly recurring SaaS subscription business. And we are very well on our way to achieve that. So yeah, so that's kind of my overall summary of the business.
No, it's great. It's super helpful. And I'm glad and appreciate you hitting on some of the capital markets dynamics in the de-SPAC process as well. I guess, look, just bringing it back at a basic level to the business itself, maybe just a very basic question for people who may not be as familiar with what the business is. Why is data management and governance complicated at all? Somebody who's only spent 2 minutes on this business or has a cursory familiarity with data could say, look, it's, why are customers paying you so much? And why are you growing so fast for this? This data is already in the cloud. Microsoft would be backing it up, presumably in the cloud. It's easy to save files and folders down. Why is this complicated? Why does AvePoint need to exist? Why do government customers, I think they're like 30% of your revenue. Why do they need this? Why do regulated industries need this? Maybe you can spend a little bit of time on that. And then we can dive into some of the numbers maybe around the addressable market.
I think the easiest way in the layman way to talk about it, right? We can geek it out, like real tech level, but the layman way to think about it is cloud is nothing but someone else's computer, someone else's data center. So while you're moving your entire compute environment from your own private data center to someone else's, a lot of the existing pain points and care that you have around data security, data governance, data compliance, data privacy still exist. They just manifest itself in a different format, right? This is why you see, for example, in the on-prem world, before cloud, for us, that's before 2010, we were really big in the on-prem ECM world. So ECM, you think about Documentum, you think about HP Trim, you think about OpenText, which is still a big company, right? Their entire business is in data management, and that's on-prem.
On-prem,
So
right?
there's an entire set of business now in cloud for data management. So Microsoft, you think of Microsoft and Google and Amazon are platform providers. They provide the entire platform. In layman's term, again, on-prem, they provide Windows, right? They provide file share. And yet there's entire business exists for Varonis to manage the additional thing on file share. And then that's the thing that we do additionally for governance purposes for the entirety of Office 365, which has 80 million users now, going towards 500 million users. So it's really, yes, the computing environment changed, the fundamental updates, upkeep, operational efficiency and security upkeep changed, that business model changed, but the inherent nature of the problem around data security and management it remained the same. And speaking of data security, right, there's a ransomware attack every 11 minutes. There's tens of billions of dollars of crypto being paid every year for ransom today, right? And that's a real problem. So for security, it's truly a multi-layer approach. The analogy I often give is it's almost like, storming the castle, right? So you have this castle on the hill. So you have to go up the hill, and then of course you have moat. And of course, then you have the wall, castle wall. Then you have the soldier on the walls. But then beyond that, you go into the courtyard, you go into hand-to-hand combat. So there's actually multi-layered defenses to protect your corporate assets. And that's what security is all about. There's no silver bullet, right? You can have the best firewall systems, the best end device controls, and somebody call in customer support and do a social engineering and still get into your account. Right. So it's truly a multi-layer approach. And what we do is we're actually helping companies and customers and government agencies fighting in the inner wall, in the courtyards, right? We help them track who has access to what, when, from where, right? Like what Varonis does for file shares, we do it for entirety of Office 365. In addition to backup services, in addition to migration, integration between different SaaS platforms like Google, Microsoft, Slack, Salesforce, right? All of that, Box, Dropbox to Microsoft, two-directional as well. And so those same problem sets exist. It just kind of in a different format in the cloud. So yes, it's boring. Most people don't think about it. Just like when you buy something with your credit card, you don't actually think about what's actually happening behind the scenes and the fund transacted between different agencies to actually get that deal done, right? Get the purchase, get the credit allocated, and then later you pay the credit. There's a lot of complex back-end processes that happen along the way. There's actually a lot of governance, right? Over the weekend, I was actually listening to a Wall Street Journal podcast about the biggest Russian hacker, how they got into the credit card system and be able to kind of read credit cards, even though the plain text only gets exposed in like a matter of seconds. They were able to steal that way. So it's actually very complex. So enterprise behind the scenes is very complex, and that's what we do. It sounds very boring to a lay person, but we do this all day long, and we grow the market, and we're a strong business, and that's just fine. We're not the latest shiny new toy that people gravitate towards, but that's also the nature of B2B business. It's not B2C. B2C consumer is very fickle. Today this thing's popular, tomorrow the other thing's popular. Whereas B2B is, it's the predictability of enterprises, of government, how they collaborate with confidence, how they exchange data securely, contract security. That's the lifeblood of business, and that's what we're protecting.
Yeah, no, it makes sense. And I see there's a couple follow-up questions too, and I want to get to those. But just on the heels of what you're saying, TJ, I want to ask one question that I know is fairly popular, and we certainly had it when we started doing work on the business. Based on what you're saying, a natural question, given this need, given the security, the threat apparatus out there, why doesn't Microsoft do this themselves? Why are they not a risk for you? How are you able to ride sort of on top of their cloud to do this and do this successfully? Maybe just address that, and then we can kick it off into some of the related questions that people listening in are asking.
I still go back to we don't compete against Microsoft. We compete within this $1 trillion Microsoft ecosystem. So just like Google, just like Amazon, these big boys, they create massive ecosystems that fosters additional innovation that also in the process allow them to be much more sticky. Our solution, we don't have overlap with Microsoft. We build on top of their services, which in turn, we also specialize in specific verticals, right? So Microsoft produces a singular cloud platform that services 380 million users. They don't have time.
Sort of a horizontal platform.
One thing, right?
Right.
And then they have
Right.
different license types, but they don't have time to
Right.
build a specific solution just for Goldman Sachs, another specific solution for company XYZ down the street, right? Maybe they will do a specific build for Pentagon because they're such a big customer, but that's really one-off. Ultimately, Microsoft wants an open ecosystem to collaborate openly. Fundamentally, that's the rub, right? In technology and the kind of like social platforms, the idea is to make it as easy as possible to collaborate and share. So, but for a regulated industry, that's actually the scariest thing, where everybody can share anything to anyone, anywhere, and anytime. That's not how regulated industry operates, right?
Yeah.
That's not how U.S. government operates. You have to control who sees what, when, and where. And again, I go back to Verona's and Symantec, all those big businesses build entire empires around that, right?
Yeah.
So that's the space we're in. And so we're in that ecosystem, and in return, we actually help Microsoft solidify their dominance within these industry verticals, right? It's a massive ecosystem. Another one, one of the things I feel that people don't realize, and then they don't appreciate the upside here, is that what Salesforce has done with Force.com to build an ecosystem just around CRM. Imagine what you can do around Microsoft Office 365, which is mission critical. Can you imagine not using Office today, right? And around Teams, around Azure, which is compute platform. Office 365 is Office Cloud. They have the compute cloud with Azure, competes against AWS. Office Cloud, the only competition is Google Docs, right? Google Suite. And then they also have Dynamics 365, which is CRM and ERP. And we also support that. So the opportunity to build on top of that, vertical solutions, it's massive.
Yeah.
It's a completely different quantum level higher than Salesforce, because most people don't know that Salesforce's entire user base is less than 10 million seats, because the only salespeople and marketing people use Salesforce, use CRM.
Right.
Microsoft
Everybody else is using the solutions, right? The other solutions.
Microsoft has 380 million user seats going to 500 million. This is just in cloud. If you include an on-prem installs, it's 1 billion users.
Right.
It's a huge ecosystem. So we're not competing against Microsoft.
Sure.
Nobody's declaring war against that. And
yeah.
And also obviously we've been doing this for 20 years, right? So we are in all the technology councils. We have, we're actually one of the top 5 global partner for them for IP co-sale. So just 3 weeks ago, we were in Miami at Ingram Micro's Cloud's biggest global event. And we were on stage with just Microsoft and Adobe. I mean, who are we, right? We're tiny compared to Microsoft and Adobe. We're top 5 cloud managed partner for Ingram. And Ingram is the biggest software distribution house in the world. We're in the same group at Ingram with Microsoft, Adobe, DocuSign, and AWS. And then AvePoint. Like compared to them, we're just, we're not 1 billion yet, right? That's where we want to get to. Same thing with Microsoft. We're top 5 also with IP co-sell in the same category as DocuSign and Adobe, because we consume a ton of Azure. We help customers secure their Office 365. We essentially help customers land onto Microsoft Cloud faster and more securely. In the process, we also consume cloud. And we also share this before, like in the next 3 to 4 years, we're estimating to burn at least $100 million on Azure. So we are.
You'll be a big customer for Microsoft.
We're a huge customer.
You're a big customer.
So asymmetrically, we're very important. So we're a very important part of the ecosystem. We're not a competitor.
Right. And I thought it was interesting too. At some point, you pointed out Microsoft's own salespeople are effectively selling AvePoint or serving as inbound for AvePoint salespeople when these customers need vertical solutions. And obviously, you have.
Yeah, the nature of the IP co-sell is that when we sell into account, 10% of TCV credits to the Microsoft salesperson for their quota retirement for cloud consumption. So they benefit.
Got it. That makes sense. And you have it's the head of Office 365 sits on your board. And
so yeah, this is public information. Jeff Teeper has been an independent board member since 2014. He heads Teams, OneDrive, and SharePoint development. Runs a 20,000 people organization. So so great industry ally to and advisor to have.
Got it. Awesome. Well, I have a bunch of other questions, but want to, obviously for the sake of people on the call, ask some of the questions that have come in So one, just to start off with, TJ, the solutions that we've articulated, you talked about in data governance and compliance data management, are these more akin to services, or are they more standardized in a way that makes it easy to sell these across a broad array of potential clients as software, presumably? I think this was a similar question was asked actually in the post that we'd put on AvePoint several months back.
So it's all SaaS software. So think of our governance solution set is almost like ServiceNow, right? It's a SaaS software where whether for small businesses, MSPs, managed service providers, for big business, they're IT. These guys are technical. They would then use our solutions to actually structure the right template, the right kind of data lifecycle management, provisioning, and then the escalation with someone coming in the organization, leaving the organization, and how to control and pass on access patterns and rights. So it's all software, right? So this 82% recurring is 100% software sell, and that's why we have the gross margins that we have, right?
Right. That makes sense. Okay, awesome. And then I guess, look, just going back to the point you made on the 380 or so million Microsoft Office users being that's just the TAM within the Microsoft ecosystem. I realize over the future you're building out into Google and Salesforce and Amazon's own ecosystems too. But realistically speaking, not all of those 380 million, whether it's going to 500 million, whatever, seats are going to need a solution like AvePoint. People don't need data governance if it's someone, a student consuming Office. What is realistically the sub? Because it's funny for us from our perspective. TAM is like one of the most abused terms in software, in internet and tech overall. People just pull stuff out of their ass all the time for here's our TAM, here's our TAM. If we think about yours, it's actually very directly quantifiable in a way. It's this 350, 400 million Microsoft users. But what of that what's the subset of that really needs a solution like this, that needs these data solutions?
Yeah, so there's multiple ways to think about it. So of the 380 million users, most of them use the base level functionalities, which is just email and then file share, which is OneDrive. And of course, they will use Teams video chatting and calling in lieu of Zoom, for example. But the more advanced workload, like document sharing internally, externally, tracking, tagging, etc., that's where really enterprise leverage our capabilities, right? Of course, backup as a service everybody can use.
Right.
So it's a way to recover from ransomware attack. This is even one of the major guidelines from White House on how to recover from ransomware attacks. You need a really good third-party disintermediated backup service. So there we have that. But also 40%, another way to think about it is also the 40% of the whole user base are in the regulated industry, right? So that's another way. So one way is to look at, hey, who among the 380, or what percentage among the 380 are getting to the more advanced workloads? And also what percentage of the 380 is in the regulated industry, right? Both things can serve us very well. So that's the other way to think about it.
So it's roughly a little less than half of that 380 is directly addressable because it's regulated industry. I assume that's financial services, healthcare, government, obviously, which is a big chunk for you. And those customers need solutions like this. Do you have any idea? Do a big chunk of that directly addressable subset already have something? You've only got 9 million seats. So does that subset already have something like AvePoint? Are they just still very, very on-prem? And so this is a natural sale to them as they move to the cloud? What's that selling motion, and how much of this can be sort of gained uncontested, or it's a natural business for you guys?
So the beauty is that nobody has the market. That's why it's everyone's racing to grab more market share, right? So we can allude to what other people have from their public releases and earnings sharing. So for example, we discussed that we don't have a holistic competitor. We have point competitors in different segments, right? So for example, in the enterprise backup as service, we will sometimes run into a Commvault. And Commvault recently discussed that their SaaS solution is doing 50 million ARR, right? So we know, okay, that's the size of Commvault's cloud backup business today, which is far smaller than ours, right? And then, of course, you also talk about Varonis. In the enterprise space, they do governance. And they also recently discussed that the size of their SaaS business is $2.5 million USD, right? So it's tiny, right? So again, nobody has the market. So it's really a lot of people using base level functionalities, and then they a lot of IT still trying to use just scripting. But
Yeah.
one thing they discover also is with cloud, and Jeff Teeper also mentioned this, in our most recent board meeting, is that people start to realize the pace of change in cloud. So Microsoft's releasing via DevOps updates to Teams every 2 weeks. We're updating our SaaS platform every 2 to 4 weeks. So to keep up with that cadence, all of a sudden there's new private channels being introduced. How do you cover that, right?
Right.
So you have to be a truly focused commercial off-the-shelf SaaS provider that really knows the Microsoft Cloud very, very well and anticipate the changes and to stay ahead of it. Otherwise, you will be not keeping up with the cadence change. And this is why the old way of scripting and to do these governance on-prem doesn't work in cloud.
In the cloud.
Right? So yeah.
How much of this was changed by really COVID, by Teams? I mean, Teams is obviously this new use case that came about, and it got almost 200 million people. They've got a lot of people using this now at this point. Really accelerated, as did Slack during COVID when people were working remotely. But your business hasn't really slowed down since, sort of post-COVID, if you can call this a post-COVID world. How much of this was Teams, the need to back up, manage, secure Teams chats? Obviously now you can invite external parties into Teams chats and share files and so forth. Is that still a big tailwind? Has that started to trail off? And really what is this longer term, larger tailwind is compliance and things like that? If you had to kind of rank order, it's easy. Everybody says cloud is a tailwind, right? That's very easy to just say. But in your case, it sounds like it's much more nuanced in terms of the pieces that are driving the growth, because you've got 110% net revenue retention. So even your existing customers are buying something else. Yeah.
I think the big change for us is, one, going to cloud, which increased our TAM significantly, and two, to do the subscription conversion. So we're much more scalable, because when you do the subscription conversion, you're cash crunched. So I always go back to this one slide in the investor deck, in the appendix of our revenue history trajectory. You will see that we historically always have high growth, except 4 years between 14 and 18. That was a bit of a plateau when we actually did a subscription conversion without borrowing money. So we just tightened our belt and did it, right? Usually, any public company will go borrow some money to accelerate that, because what that does is it leads to immediate cash crunch. So we were always very disciplined, and to date, we have no debt on our balance sheet. But to your point of where is the tailwind? So what Teams did is introducing additional tip the spear for us. The way we design our SaaS platform is to follow the end-to-end journey, right? The natural life cycle and cloud adoption journey of an enterprise. You go migration first, integration. Once you're there, you have enough data, you care about backup because you want to protect against ransomware attack. And then after that, you have a lot of data you need to care about sunsetting. You need to care about record management. You need to care about data privacy and compliance. Those are all after the fact when you're mature enough, right? So that was the natural journey, and that's what our product are set out to do, follow that natural journey. What COVID did was all of a sudden everyone started to open up Zoom, everyone working from home, everyone using Teams with no governance and no control. All of a sudden you have data sprawl. So this is why Citibank, the first product they deployed from us is actually Teams governance. And not even migration. Teams governance is the first product, because they realized without proper governance, they can't open up the advanced feature of Teams, which is document sharing, co-authoring, and all that, and workflows. So that's where it introduced a new tip the spear for us effectively to have the conversation. So we don't have to follow the natural kind of the life cycle of the cloud adoption journey. So as people use more Teams, there's more advanced workload. So I would say the big driver continue to be, as folks get more used to the cloud, they start to pick up more advanced workloads. That will drive more number for us. And also we are already supporting Salesforce, supporting Google. We're doing meaningful revenue there already. And today we just announced that we support Azure, which is a huge space and adjacent space. Azure is actually growing much faster than O365. So that's another revenue source for us. So we'll continue to support additional platforms, and that will be another growth driver. And the third really big growth driver, of course, is industry solution. We talk about education, right? This going back to my earlier comment, folks don't underappreciate the massive business application capabilities to plug into Microsoft Cloud and create a much bigger business opportunity like Salesforce has done just on CRM alone. That's another major driver for our growth. And lastly, of course, we talk about channel. So we have been doing hard work first. We always do direct sales. We also handle some of the toughest customers, the state departments, the U.S. government, some of the toughest, Nestle, right? Very tough customers. We start there, direct sales, enterprise. And now because SaaS, that same enterprise grade SaaS solution is accessible to SMBs, we're growing really, really fast in SMB. We talk about 10% of our ARR this year is SMB, really MSPs. We're treating MSPs as a new vertical, just like government business. And MSPs, as everyone know already, are very clearly defined by Dado, right? It's a specific vertical. These are managed service providers that provide cloud data management and consulting services for small businesses, because small businesses don't have IT. And there, we 100% digital, no human involvement, and we do monthly contracts, highly recurring. Even gross retention is in the high, mid 90+%, right? So that piece of business for us, we forecast it in the next few years have a potential to be at least 30% of our ARR. It's huge, right? Because for Microsoft, that's a very big space. So all of a sudden we have purpose-built UI, UX, front end, same back end SaaS for MSPs, allowing MSPs from a single pane of glass to manage hundreds of tenants, hundreds of customers in one go. And that's a different experience. And now we're opening our APIs so MSPs can plug in and build their own unique IP. We have MSPs that only operate in the legal industry. We have MSPs that only operate in the insurance industry. By accessing our APIs around data governance and control and security, they can build their own unique IP. So now we're doing a force function around ecosystems. This is where our acquisitions come in. This is where our investments are coming in. So there's a lot of different ways to grow this business. It's really, really exciting. It's a
good point. And it's one of the questions that's come up too on the sort of other growth avenues. I want to get to it, especially that point you made, TJ, about the verticalization. But I'll kick it over to Jim for the next question, just to give you a breath before Jim falls asleep over there. Jim, one of the things, and this is just to bring it sort of back to the numbers, a lot of what TJ's articulating. Anybody who cracks open the financials for AvePoint, it may get a little confusing at first. You guys talk a lot about recurring revenue. You say it's 80% plus of the business. And, if we can just address kind of how, why is it truly recurring? ARR is again, one of these like abused terms in SaaS and in tech. People love to throw everything in ARR. So maybe just talk about that, because your financial statements show a SaaS line, but then they also show term license and maintenance. And that's confusing. That's what's more associated with legacy software businesses. Obviously, you guys have been around for a while. So just touch on why should anybody consider term license and maintenance to be recurring revenue?
Yeah, no, it's a great point, Raj. And you're right. It can be confusing, right? We've had people think that term license was synonymous with perpetual license. And no, it's not. Term license is much more of a subscription that people are renewing those either on an annual basis, or we do have some term licenses that go out to 3 years. As TJ had said, our average is 2.2. So there's definitely that. But yeah, so the SaaS is kind of when we host the environment, we get to consider that SaaS. So everyone would think of Salesforce and it's like, yeah, they never had an on-prem solution or an alternative other than if you wanted to work with Salesforce, you had to use their cloud. That was the only choice. We've provided, and since we grew up from the perpetual world transitioning into SaaS, we have much more of a satisfying the customer's needs and trying to address their concerns as they want to see it, which in some cases is not allowing us to help host the platform and them accessing our network. They either have their own private cloud that they want to sit in. They have their own Azure instance. They have.
Is that a lot of government? A lot of government wants to use private cloud?
Yeah, a lot, but not just government too. Some of your major corporations, and we're even seeing this. We saw it even more in Q1, and now it continues in Q2, particularly with all the geopolitical, issues that we have going on. People want to definitely be much more in control of their own destiny, which is, hey, I want to host it in my cloud. I want to have full control. I wanted it to be geographically close to me. Maybe I want to have, that kind of control and that differentiation. So we're seeing that more and more where people want to be in kind of environment. And we allow for that, right? We're trying to accommodate the customers as they want to do business. And so, but if we do that and allow them to keep it in their environment, then it turns into a term license for us, because we're not hosting. So that's almost an accounting rule thing, as opposed to because we look at it from layman's terms, it's still a subscription.
Right.
And so therefore, we think of term license and SaaS as really the same. It's a subscription that will renew hopefully every year or every couple of years, whatever the term is. But almost in fact, the term license is actually almost less costly for us because we're not hosting the environment. So we don't have the Azure cost.
Right.
The customer would have the Azure cost. And then, like you said, the maintenance is still that recurring nature, just like we all remember maintenance contracts. So that actually works. So in our ARR, we actually feel like we do a good job of not throwing the kitchen sink in. We actually just have those basic elements. It's our SaaS platform, our termed license, and the maintenance recurring. And we don't even include the migration component in the ARR as well, because that's a piece that arguably is less recurring in nature because of the software is much, more of a one-time use, although people do use it more than once perhaps, but much more of a one-time. We exclude that from ARR. And I'm sure some of our peers and competitors would include that in ARR, but we exclude that because, again, we don't think that meets that definition of truly a recurring type as some of the other products are.
And you elected in, I think, Q4, Q1, basically this year to sort of even further handicap yourself and take more of that term license and stretch it out even more such that it would impact your revenue growth negatively. But that only happens for 1 year. So your revenue growth dips below your ARR, but then next year going forward should actually start to match it.
Yeah. So touching on that point. So we did that in Q4. And really kind of after I rejoined and kind of thinking through and looking and understanding the revenue, our components and trying to really figure out like, hey, what's our best approach? And what I recognized, or we recognized, was that we were recognizing a ton of that term license up front. Literally 75% of it was up front. And although that legitimately may have made sense from the accounting rules and whatever else, it just created such a dichotomy between that and our SaaS platform that it just didn't make that much sense. So we went back and looked at all the numbers and came back and said, you know what, if you actually look at all the detail, and there's some methodology to this, I won't bore you guys with the accounting behind it, but effectively what happened, the end result is taking that 75% down to roughly 50%, so that we're recognizing about half of that revenue up front and then amortizing the remaining 50% over the life of the contract. So again, it's a little closer to your point, a little closer to our SaaS recognition. And in last year was about a $4 million negative impact adopting that. This year, it'll probably be anywhere from the 8 to 10 million negative hit that's already baked into our numbers. And then going forward, we start to see that kind of turn around, right? Because now you have the effect, the reversals, and the that going forward. So again, we see this again as the right thing to do, regardless of at the time it was painful to explain to people and go through, hey, we have an accounting change. But we think it's the right thing to do, number one. And then ultimately it provides a little less lumpiness in terms of the difference between our term and our SaaS. So again, we think a positive.
That's helpful.
Yeah.
Got it. Great. Well, look, there's two questions. There's more than two questions in the queue from people listening. One of them, and I'll kind of merge the two. One is, look, what is AvePoint doing to increase and accelerate total revenue going forward? I'll merge it with another question, which I think is somewhat related, which is the cash from the SPAC. How is that going to be used? Acquisitions versus organic growth. So I'll throw those out to whichever one of the two of you sort of want to take that, but we can go in that order.
Yeah, I think I shared that earlier, right? We actually are still looking at those 5 vertical of growth, right? Obviously, the channel with the selling to the MSPs, and channel is actually even bigger than SMB, right? It's also mid-market, EPG, and we're aggressively going that route to reduce deal cycles and increase the ramp-up time. It's also a really good way to actually introduce new sales into that flow so that they can actually start out very much quicker. So I think we discussed this previously. We say, hey, when we hired a lot of new salespeople at the beginning of 2021, and we see different pace of ramp up, right? So in places where we have channel work out really well, the ramp up is very fast, and we're now doing that globally. So that's one thing. Obviously, the other thing, of course, is the continued just seed game, right? Just expand And we actually disclose on an annualized basis the active seats we cover, right? So C gain just expand the surface area. And of course, the third one is customer success to continue to increase upsell capabilities. This year is the first time we actually have upsell quota at the rep level. So to the extent that every rep actually have now a total annualized quota that's different from every other rep because it depends on what patch of accounts you own, how much you cover, and of course you have new logo acquisitions. We also got rid of service quotas. So again, as a way to intentionally reduce services to focus on premium software, that also allow us to incentivize the channel. We actually have our stats from my chief product officer. For every dollar the managed service providers, the partners actually invest in us of our governance software, they generate $7 of service opportunities to create for their business, right? So that's a force function that helps build the ecosystem, in return build enrich the channel. Of course, the fourth one is the vertical solutions. We talk about edutech, we talk about government, we talk about banking, we talk about manufacturing. We have vertical solution in all those spaces, and we'll continue to bake those on top of our governance and confidence platform, this data management SaaS platform. And we think that's the way to continue to increase ARPU and be able to.
Is that vertical solution growth strategy? It's obviously new. You've done one deal there. Is that a good example of inorganic cash deployment? Like that's where you're going to go potentially find point solutions?
So we announced one large deal. We've done many deals. So the vertical solution is actually a pretty significant portion of our revenue stream, and we have others. We just happened to announce, that $25 million deal that we did.
Yeah.
So it's meaningful to announce large deals so that people know that we actually operate in very primarily in the enterprise space as we take our time to grow the channel and grow the SMB, right? And the last one, of course, is international expansion, and that's again. With the help of channel, we're now selling into LATAM, we're selling into Africa, and the markets we don't need to have physical presence in. And that's really fast acceleration through 100 digital marketplaces around. So those are a way to grow the revenue. Now, how do we use the proceeds from our going public? Of course, we're using it to invest internally to grow our headcounts, grow our sales organization, grow our customer success organization to increase upsell, cross-sell capabilities, increase market share. The other one is invest into product development to actually have new products. Third one is obviously buying companies, and we talk about we have active pipeline. We'll announce more acquisitions and that. And then the third one, lastly, we also are looking at investing opportunity to again force function the ecosystem. There are partners that we don't necessarily the really cool IPs. We want to invest and be part of our ecosystem. So those are the ways to leverage the capital in addition to stock buyback, right? Which is creative. It's good for shareholder value. All these things we're doing while maintaining annualized cash flow positive. So those are the navigation, the North Star for us.
Yeah, and it's interesting. It's and you mentioned the hiring. You're still hiring. Obviously, there's a lot of news lately with the turn in macroeconomic conditions. Some companies are on hiring freezes. Some companies are starting to announce reductions in force. How has what's gone on overall changed the way you guys are prioritizing growth versus profitability going forward? Do you pull back on some of the hiring? Do you pull back on some of the marketing investment? Do you pull back on some of these things? And if you do, does it have an outsized impact on growth? Maybe just talk about that equation a little bit.
That's a great question.
And if it's changed at all.
Yeah, that's a great question. I think profitability more than ever is very important. We get that message loud and clear. And I mentioned earlier, we are already incorporating the stock-based comp into the budgeting process so that we want to reach profitability, not just cash flow positive, right? So, but cash flow positive is very important because cash is king. In time of inflation, in time of massive economic uncertainty and volatility, you want to make sure you always have positive cash stream, right? So you'd never be in a bad position to borrow against the ever increasing rates. Now, what's happening in the world of this anti-globalization, we actually now call it hyper-localization. We're in 17 uniquely premium one, top tier B2B software markets, right? The Japan of the world, Australia, Germany, UK, France, Nordics. So we actually, in those markets, most of those markets, we've been there 10 years, 15 years. And we are actually really very much of a local trusted partner and provider. So in Singapore, for example, we were the APAC top Microsoft ISV partner, right? Singapore country level partner and also APAC partner. So that allow us to provide that even above and beyond, right? We don't want to always view as an American software company. In those markets, we could be a Japanese company, we could be a German company providing value. And with this war in Ukraine, Raj, I tell you, first time, tier one German customer coming to us say, hey, we want hybrid deployment scenarios. And by hybrid, I don't mean multi-cloud. I don't want my stuff to go from Microsoft Cloud to Amazon Cloud because those are all American providers. I want the stuff from Microsoft Cloud go to my on-prem or my German-based data sovereign-aware private data centers. So there more complexity is happening. More regulatory walls are coming up. And that is actually our wheelhouse. We're born and grew the last 20 years in the regulated industry. So as the environment become more challenging, this is what we do. And also, obviously, everyone know, right? We are in a digital age. That's not going to go away. That's mission critical. Nobody's going to go back to paper and pen, right? Yeah. More automation, more productivity improvement. It's what going to help business thrive and be competitive. And that's, again, something that, again, in our wheelhouse. And for that, we feel very fortunate. We just had a leadership offsite 2 weeks ago. I said, ladies and gentlemen, we're very fortunate to be in this space that we are in, because what we do is mission critical. And what we do is even more important in this anti-globalization, highly volatile climate that we're in. So yeah, we feel very fortunate. We're in a really good spot. We feel the pressure. Pressure is a privilege. We're privileged to have the pressure, and we'll continue to execute. And then the market will see and recognize us, right? It literally takes, I have good friends at Fidelity, as I say, hey, he was very conservative. He said it takes 2 years to shake up SPAC tent. Some say 1 year, right? But we're coming up to our 1 year anniversary here. So we are going to continue to execute and prove to the market that this is a company that's going to be the next multi-billion-dollar, revenue company.
Got it. That's great. I'll ask, with a few minutes left, I'm just going to ask some of the questions that are coming in as well. Just on the sponsor, just what value have the sponsors, the SPAC sponsors, board members been providing the company since you've come public?
Well, Jeff and Brad are excellent board members. They have served on many public boards. This is my first time starting a company, my first time running a public company, right? I am learning. We're always humble student business. There are always things we don't know. This is the first time of us doing this, but we're learning very, very quickly. And in that regard, Jeff and Brad, they're fantastic governors, stewards for us. So obviously, even he mentioned, right, this was before we go public, he said, the board's job is to hire and fire CEOs. I hear that loud and clear, right? I want to be a good CEO. I want to be a good steward of the company and carry the mission forward. So they are very good when it comes to governance. They're very good when it comes to compliance and thinking ahead, because they have seen how to go from Oracle, several hundred million to multi-billions. Okta, right? Twilio, same story. Right. They've seen this movie played out so many times, and we're doing the same thing. So that kind of experience, it's fantastic at the board level. And we also added a new board member, Janet Shines, who Forrester calls the #2 most influential channel chief and influencer in America. She's the ex-channel chief for Verizon. Fantastic board member, right? So that's all going to help us.
Got it. That's great. That's great. Well, look, I want to keep this at an hour, but I'll just ask, just as we creep over here, are there any other questions that either I missed on that you guys may have seen come across, or that you're getting asked? You guys have done quite a circuit, I think, over the last 3 weeks or so of meeting with investors, that you're getting asked that I didn't ask about, or what weren't asked about on this call, or that you really think, look, people are missing here?
Yeah, I think we just need to do a better job and continue to educate and increase awareness. We, in the past, we were kind of spoiled, right? Because we were in the regular industry, we're the enterprise. In the enterprise segment, everything is by reputation. It's enterprise customer, like a State Department, they will always do bake-offs. They will compare 10 different solutions, pick one. So it's truly your technical excellence that win you the business. But now we're a public company, we're addressing SMB, we're addressing channel. So the brand, the marketing, the awareness need to be much more. So that's something that we're also improving and working on aggressively. Lastly, as a public company, we do need to do a better job in communicating with our investor community, whether it's retail and institutional. So now we're doing a lot more of that. Jim and I have been on the road, going to different conference circuits, doing fireside chats. Raj, you watched several of them, right? We're going to do more of that. It's education to get the story out there, because at the end of the day, AvePoint is a boring data security and governance company. How do we, get beyond that? And honestly, like ServiceNow, I actually went to ServiceNow for a whole day. They pitched to me, and it took them like 6 hours to explain to me the complexity of the software. It's very complex stuff. What they do is also very boring, but what they have done is very successful. So that's kind of like our new, model of success. How do we do that and return ultimately shareholder value?
Yeah. And just one last one, I'll sneak in here, guys. Just regarding the buyback, how you guys are thinking about that and the timing. Also, just this notion. It's interesting. You guys are there are a number of de-SPACs that have come public, the vast majority of which have seen their stocks get cut in half or more, and a few have announced buybacks. It creates a problem sometimes because it reduces liquidity. And one of the problems inherent in the de-SPAC process is high shareholder concentration. So liquidity is pretty low. Are you guys, did you decide to do the buyback? And I'm curious the pace of it and how you think about that. But did you decide to do it in spite of any concerns around liquidity? Were you getting any pushback from institutional investors around, hey, if you actually reduce the share count or reduce the float here, that's going to create, an even bigger problem here? And look, maybe that's an opportunity for people in the sub-zero community to get involved when there's less liquidity for larger institutional investors. But I'm curious how you thought about that.
Yeah. Jim, you want to go first?
Yeah, I'll start that one. Yeah, so we got lots of feedback when we started talking about it. And I will tell you, all the feedback was very positive in terms of, initiating a stock buyback program. Now, I think the other advice we got was to be measured and not be overly aggressive. We're going into some, uncertain. This is, again, we initiated this, a month and a half ago, 2 months ago now. The economy was a little rocky at that time. We weren't sure where things were going. So people were saying, hey, you should be measured. We think it's a great idea. We're supportive, but be measured. So we've taken that approach in terms of, we've been very consistent in what we've been doing week over week. As TJ mentioned, we had only been, when we announced the buyback program on our last earnings call, we had been like 6 weeks in to the program, and we had spent just under 5 million and acquired just under 1 million shares. But we've continued effectively at that same pace since. So we've been very measured, not overspending or overcommitting. We really want to use as much as possible in terms of driving the business forward, as opposed to just buying back shares, although we think that is good shareholder value to do that as well. We think the greater value comes by growing the business, and that's going to come both from internal and then some inorganic growth through acquisition as well.
Great. Fantastic. Well, gentlemen, I'll leave it at that. Really appreciate the time, and hopefully this was helpful to everybody on the call. It was certainly informative for me. We'll leave it there. Best of luck. And Jim, enjoy Naples. Unfortunately, not Italy. Naples, Florida. It's still nice.
Yeah.
And TJ, we'll talk soon.
Yeah. Thank you, Raj. Thank you for your time.
All right.
Thanks, Raj. Okay.
Bye.
Thanks, everyone.